Good morning, everyone. So today I am going to solve several important questions from chapter long-term liabilities. So the problem one is about bond discount amortization. So bond discount amortization is the first question is about. So let me read the question. So the face amount of the bond is $100,000. The interest rate from the company side 40%, 14%, and interest is paid quarterly. Interest is paid quarterly. It means that 4 times a year. 4 times a year. So it is March 31st, June 30th, September 30th, and December 31st. So 4 times a year, this company paid their interest. Terms of the bond 5 years, and market interest rate is 12%. So based on this number, 4 times a year, we have to compound. We have to compound our interest rate and term of the bond. Equal 3.5. So new interest rate is 3.5%. It is the contractual interest rate. So what about the market interest rate? Equal 3%. So market interest rate now 3%. Then contractual interest rate now 3.5%. And we have to also compound our time periods. So times 4. Equal 20. So now new compounded time period is 20 years. And based on the company rate, you have to calculate the interest expense. Our interest expense now it should be $100,000 times 3.5% equal 3,500. 3,500. This is our interest expense. So now we know what is the face amount, $100,000. We know our interest expense is 3,500. Okay, we know term of the bond 20 years, and we know the market rate is 3%. Now question 1 said that determine the price of the bond. What is the meaning of price of the bond? That means you have to calculate the present value of bond. We have to calculate the present value of the bond. So this is our first requirement. After calculating the present value of the bond, the question said that record journal entry for issuance of bond. Record journal entry for bond issuance. So we can see it now. So how to solve this question? First, face value of bond is given. Face value of bond is given. It is $100,000. Then how to calculate the present value? You have to calculate present value of principal amount. So you have to calculate the present value of principal amount first. It is 100,000 times factor. And how to find the factor? How to find the factor? So I equal 3% because market rate. We use market rate. We use market rate to calculate the present value. So I equal 3% time equal now 20 and table, that means, and present value table. Present value table. So based on these three informations, we have to calculate the factor. So the factor here is, if you use table 2, because table 2 is about present value table, because future cash flow $100,000 is only one time. As future cash flow is $100,000 only one time, we are going to use table 2. And by using table 2, interest rate 3%, time period 20, we can find the factor. So the factor here is 0.55368. So this is the factor, and based on this factor, the present value of principal amount is 55,368. Okay, so this is the present value of principal amount. Now we have to calculate the present value of interest expense. We have to calculate the present value of interest. And our interest expense we already calculated here. Our interest expense is 3,500. Interest expense is 3,500. Then we have to find out the factor. Now this 3,500 is more than one time, right? That means 20 times. So we are going to use present value of ordinary annuity table, not present value table. So we have to use table 6. So not table 6, table 4. Present value of ordinary annuity table we have to use. So by using this table, the factor here is 14.87747. This is the factor. Then we find the number, it is 52,071. So what is the present value here now? Now present value is, that means present value of bond. This is our requirement 1. Requirement 1 said that calculate the present value of bond here. Determine the price of the bond means the present value of the bond. So the requirement 1, present value of the bond is 107,439. Yes. So this is the present value of the bond. So we find that the face amount of the bond is $100,000, but the present value of the bond is $107,439. So there is a difference. And what is the name of this difference? It's called premium. So this is the premium on bonds payable. So the premium on bonds payable is the difference. Why it is called premium, why it is not discount? Because we are going to receive more money than our liability, right? This is our liability. Our liability is $100,000, but we receive cash, okay? So that means this is the case, cash receipt. You received cash 104 $107,439,000, and this is your liability. So you're liable to pay back, okay? You are liable to pay back $100,000. You are liable to pay back $100,000, but you receive cash. You receive cash more, right? So the difference is called the premium. So here the premium is $7,439. Now this premium is for how many years? This is for 20 installments. So this amount is for 20 installments, right? 20 installments. So we have to convert, because we have to convert this 20 installment into per installment. Why? Because we have to follow the matching principle. And this additional amount, the premium, this premium is the money we no need to pay. We are liable to pay $100,000. We are liable to pay $100,000, but we receive more money. So this more money we no need to pay, right? So this is one kind of gain. This is one kind of gain we no need to pay. That means, what is the meaning of gain here? Here it means that your interest expense is going to decrease, right? So this money you no need to pay means it is one kind of gain, and it is another way you can say that this money you no need to pay. So per installment, premium. The per installment premium equal this amount divided by 20. Okay, so divided by 20, and it is $372. $372. Right? This $372 is the per installment. Is the per installment, and to do so, we follow a straight line method. To do so, we follow the straight line method. Follow the straight line. So mainly our answer is up to here. For the first requirement, this is our answer. This is the answer. Requirement 1 said that calculate the present value of the bond. This is the present value of the bond. We receive cash today, but we are liable to pay back this money. And we do some working here. We do some working here that the difference is the premium, and this premium is for 20 years. So we are going to allocate this 20 years for per installment, and it is $372. Now we have to record journal entry for this. We have to record journal entry for this. So what is the journal entry? So here you can see that we receive cash $107,000. So we receive cash. We receive cash debit. This is the money we receive today, and we are liable to pay this is our liability. Our liability is $100,000. So we receive higher amount, but our liability is lower. The difference is called premium on bonds payable. So premium is one kind of gain, and gain is credit. Premium on bonds payable credit, and it is this amount. Then you have to write a narration, record issuance of bond. This is a short narration to record the issuance of bond. So this journal is our requirement 2. This is requirement 2. Requirement 2. Because requirement 2 said that here, this is the requirement 2. Prepare journal entry, right? Prepare journal entry to record bond issuance on January 1st, 2022. So this is January 1st, 2022. Okay, we record the issuance of bond. And this is the requirement of 1. This is the first requirement. This is the requirement 1. What is requirement 1? Requirement 1 says that calculate the present value of the bond. So requirement 1, we calculate the present value of bond. Now we are requirement 3 and 4. So requirement 3 and 4, same journal, because interest expense, you can see that the question said that we have 420 installment for interest, right? So 4 times a year, every year you are going to pay interest 4 times. So within 5 years, you are going to pay interest how many times? Within 5 years, you are going to pay interest 20 times, right? So this 20 times, the journal entries are same. Every time journal entries are same. So the question said that no need to record journal entry for 20 times, okay? No record journal entry for 20 times, only record journal entry for March 21st and December 31st of year 1. Okay, according to this question, they said that record journal entry of interest expense, record journal entry of interest, not for 20 times. For how many times? Only 2 times. One is March 31st and another is December 31st. So for your information, total 20 times, all are similar journal. Now let's see the journal entries. Interest expense debit. Now, what should be the interest expense? According to this question, our interest expense is 3,500. I calculate here. Our interest expense is 3,500. Our interest expense is 3,500, right? But as it is a premium bond, you can see that this is the gain. This is the gain. $7,439 is the gain, right? We no need to pay this money. We no need to pay this interest expense. But this is for how many times? This is for total 20 times, right? We are going to allocate them for 1 time. So this money we no need to pay. So this is our good news. Our good news is our interest expense is not $3,500. As it is a premium bond, this money we no need to pay for per installment. Yes. So this $372 is the gain, right? We don't need to pay this. So interest expense debit, and after calculating this, it is $3,128. $3,128, not $3,500. Now you can see that we allocate this money where? This is the premium on bonds payable is credit, right? This is credit. And we allocate this money to interest expense as a minus, right? So that means that this amount is going to decrease. Every installment later, this money is going to decrease. Why this money is going to decrease? Because it is going to allocate with another account, right? It will decrease and it is going to allocate with another account. So bonds payable, you can see that premium on bonds payable increase credit. Now it is going to decrease. Now it is going to decrease. So now it is debit. Premium on bonds payable, this amount is now debit. Because previously we record credit. Now we allocate this money to interest expense. So this is going to decrease as a debit. Now we pay cash. We pay cash is 3500. So here you can see that our interest expense is lower. Our interest expense is lower, but we are going to pay cash. We are going to pay cash $3500. So why we pay more money? Because we already received cash here, right? So this two account is going to adjust it. Our liability, look at here, our liability is $100,000, but we receive more money, right? We receive more money. So this money is from here. Although we pay, look at here, although our interest expense is lower, but we pay cash is higher, but this cash is going to adjust it already here. Clear? I repeat again, although our interest expense is lower, but we pay more cash, right? So don't worry, we pay more cash. It means that we already received this money. We already received this difference. We already received this difference. It is including the present value of cash that you already received. So what is the narration here? Narration is here is to record interest expense. To record interest expense. Now I told you that this is the journal entry for how many times? For 20 times. 20 times the same journal entry. So that's why I just copy and paste for another installment. So these two, look at here, these two journal entries are similar. These two journal entries are similar. Interest expense debit, premium on bonds payable debit, cash credit, and the amount also similar. And this should be done for 20 times. So, but your portion said that no need to do 20 times, do it only 2 times. So we done requirement 3 and 4. So this is requirement 3. And this is requirement 4. So we done requirement 1, 2, 3, and 4. What is the 5-1? 5-1 said that record the journal entry for the payment of bond at the maturity date. So what is the journal entry when you payment the bond? So this is opposite. Like today you receive cash and record bonds payable credit. Now you have to record bonds payable debit, because when you pay them cash, your liability will decrease. So this is our liability. This is our liability debit, and we pay cash credit. And the narration is to record payment of bond. Record payment of bond is the narration. And this is requirement 5. Yeah, because maturity date is 20 years later. So just you can write here maturity date. So whatever the date is not an important issue. This is the last day. This is the last day of the bond time. So we have to pay back the cash and we have to close our liability. So this will happen actually 5 years later. Okay, this will happen actually 5 years later. Now question 2. Question 2 is about, so this is not bond discount, this is bond premium. So this question is about bond premium. Now we are going to see question 2. This is about bond discount. It's about bond discount. So here, the face amount of the bond $100,000, contractual interest rate 12%, market interest rate is 14%. Market interest rate is higher. So if market interest rate is higher, okay, then we will have discount here. And interest is paid quarterly. So it means that 4 times a year. So based on this number, we are going to calculate the compounded interest rate and compounded time period. So now interest rate, you can see that for company interest rate now 3%, and market interest rate is now 3.5%, and term of the bond 20. So now question said that again calculate the present value of the bond. Calculate the present value of the bond. So we can do it now. So face amount of the bond $100,000. Now how to calculate the principal amount of bond? So you can see the changes here. Here we are going to change the factor because we will have a new factor. Based on, now we can say that market interest rate before it was 3%, now market interest rate 3.5%. Market interest rate 3.5. So this is 3.5. T equal 20 years and table is table 2. And now we have to find a factor from table. So if you find table accurately, the factor is 0.50257. 0.50257. So this is the factor. We use table and find the factor. So the number here is 50257. Now present value of interest. Now our interest expense is $3,000. Then again you have to find a factor. You have to find a factor for 3.5%. 3.5%. Term 20 years. Present value of ordinary annuity, table 4. And you can use the table accurately and find the factor. It is 14.21240. So after doing factoring, the number is now 42,637. And the present value, that means the cash you received today, is 92,894. 894. This is the present value of bond today. Now the difference is called discount. The difference is called discount. Why? Because you receive less money. You sell your bond with a discount because you will receive less money. What is the amount of the difference? The difference is 7106. So this is the deep discount. Look, you receive less money, but in future you have to pay higher money. Now this is the difference discount on bonds payable for 20 installments. So we have to calculate per installment discount. So this $355 you have to pay additional. Why you have to pay additional? This is included here. Look, you receive 92,894, but you will pay more money. That means that you are going to pay this additional money. Okay, you are going to pay this additional money here, right? The additional money, you have to record this additional money every year, but when you will pay this, you will pay this at the end of the maturity. Okay, look at the journal entries for the requirement 1. According to requirement 1, we receive how much cash? We receive $92,894 cash we receive. So this is debit, cash debit. So this is our cash and this is our liability, right? Our liability. So the remaining is the discount. It is our loss, or it is debit. Discount on bonds payable. So this is the first journal. We receive cash $92,894,000, and our bonds payable liability is $100,000. The remaining is the discount, and the amount here is this amount, the 20 installment amount. Now, how to record interest expense? We find that our original interest expense is $3,000. This is the original interest expense, $3,000, and per installment we have to pay more $355, right? Because you receive less money, in future you have to pay more money, right? So this is your interest expense, additional interest expense. So original interest expense, you can see that original interest expense is $3,000. From here, original interest expense is $3,000, but we have to pay some more money. So this money we have to pay more. So the debit is okay, but how much cash you are going to pay? You are going to pay cash $3,000. So your interest expense, look at here, your interest expense is $3,355, but you are going to pay cash $3,000. So you are going to pay less money, right? You are going to pay less money. And when you will pay this money, you will pay this less money. That means you pay $355 less. You will pay this money at the maturity date. It is included here. So now discount on bonds payable is going to allocate with interest expense. So when it is allocated, it is going to decrease. So decrease means it is now credit. You understand? Like premium, we are allocate. This is 20 years. We are going to allocate this to the interest expense. So this discount on bonds payable account is decreasing. Decreasing how much? $355 decrease. Yes. And the same journal is for here. So this is the interest expense, debit, discount on bonds payable credit, and cash credit. And this is the last date journal. At the maturity date, you pay them $100,000, although you receive $94,000, but you are going to give them more money, right? This money include, do you know that this money include this amount plus this is the additional money. This is the additional money. So additional money is the additional interest expense. So this is the money you will pay in future. So your cash decrease $100,000. It came from here. So although today, look at here, although today we pay less cash for interest expense, our interest expense is higher, but we pay less cash, although it is less cash today, but this cash actually going to pay at the end of maturity. Okay. So this is about question 2. Then what is about question 3? Question 3 is about bond redemption, that means buyback bond. Buyback bond. Now let's read the question. On June 30, 2020, ABC company calls bond with $50,000 face amount. Okay, $50,000 face amount means it is called bonds payable. Bonds payable. So bonds payable is $50,000, and the remaining is the discount on bonds payable. So remaining is the discount on. Okay, so the remaining amount is called discount on bonds payable. Bonds payable, $20,000. Anyway, so we know what is the amount of bonds payable. We know what is the amount of discount on bonds payable. Okay. Then, based on this information, can you calculate the carrying value of the bond? What is the carrying value of the bond here? What is the carrying value of the bond? According to this example, this is 50,000. Then 50,000 plus 20,000 or minus 20,000. It is a discounted bond. It is plus or minus. Minus 2,000. According to this example, $48,000 is the carrying value. Okay, according to this example, $48,000 is the carrying value. Yes. Now, requirement once said that June 30, 2020, the corporation buyback. Okay, redeem means buyback, right? Buyback 1/2 of these bonds. 1/2 of these bonds means, what is the meaning of 1/2? That means 1 by 2. That means equal 50% actually. So June 30, they buy back 1/2 of the bond. 50% of the bond they buy back. Okay. 50% of the bond they buy back for how much? For this money. So from here, can you tell me you have a gain or loss? You have any gain or loss for this transaction up to here? Loss. Why? Because this is the carrying value of the bond, right? This is the carrying value of the bond, and times 50% equal $24,000, right? $24,000. $24,000 you buy back, but cash paid is $26,000. So you pay more cash than the carrying value. So 50% carrying value, look at here. 50% carrying value is $24,000, right? And you pay cash $26,000. So we have so this is not loss, we can say that carrying value. So carrying value is $24,000. We paid cash 26,500. So we have a loss here. Loss here is 2,500, right? 2,500. Now we have to do the journal entry for this. We have to do the journal entry up to here. Now, what is the journal entry? So you have to remember, we have to close. We have to close bonds payable, because buyback means you have to close your bond, right? Can you remember? You have to close bonds payable. You have to close bonds payable. You have to close. You have to close discount on bonds payable. So these two accounts should be closed. These two accounts, because you buy back. Okay. So we should close how many percentage? We should close 1/2. We should close 1/2 of bonds payable, and we should close 1/2. Okay, 1/2 of bonds payable, because requirement said that. Requirement said that you buy back 1/2. Okay, requirement 1 said that you buy back 1/2, right? That means we have to close 1/2 of bonds payable. We have to close 1/2 of discount on bonds payable, and we already calculate our loss. Okay, we already calculate our loss. So it is discount, right? Go back to the journal here. So bonds payable credit, right? To close, what should you do? You can see that our previous transaction, our main journal bonds payable credit. If you want to close it, what should you do? Like here, we pay money and we close it, right? So bonds payable normal balance credit. So if you want to close it, it is debit. Look at it, discount on bonds payable. Discount on bonds payable normal balance debit. If you want to close it, look at here. We want to decrease, close it, it is credit. So according to the journal, bonds payable debit. That means it is close. Bonds payable debit close. Discount on bonds payable credit, it means that close. So one half we close. One half we close, and it is something like total is $50,000. Total is $50,000 times one half. It is $25,000. So $25,000 close. Here discount was $2,000. Discount was $2,000 times one half. That means $1,000 close. It is $1,000. The question said that 1,000, yes. So we close bonds payable. We close discount on bonds payable. We close discount on bonds payable. So these two accounts already closed. Now we pay cash. We pay cash credit. We pay cash this money. So cash credit. Cash credit. Okay, and we have a loss on bond redemption. Debit. We already calculated the loss. It is 2,500. And what is the narration? Narration is to record bond redemption. This is requirement 1. This is the requirement 1. This is the requirement 1. Requirement 1 said that record journal entry assume that on June 30, 2020, corporation redeemed one half. One half means 50%. 50% of the bond for this amount. Requirement 2 said that, you can see that. Requirement 2 said that company redeem remaining bond. What is the remaining? So before the carrying value was 40,000, 50% you redeem. You redeem, now you have remaining another 24,000, right? Total is 48. Look at here. Total is 48. 24,000 already redeemed. So we have remaining 24, right? How much cash we paid? We pay cash 22,500. So this is the remaining carrying value. Remaining carrying value. So remaining carrying value is $24,000. Okay, remaining carrying value is $24,000. And we redeem this. We receive $22,500. So we have a gain or loss here. We have a gain. We have a gain because we pay less money than the carrying value. So 1,500. 1,500 is the gain, right? 1,500 in the gain. So we can follow the journal entry. So we close remaining 25,000. We close remaining 25,000. So remaining 25,000 close. Then discount on bonds payable close. Remaining discount on bonds payable. Remaining discount on bonds payable close. This is 1,000. So we close this two, and we have a gain. We have a gain, and we already calculated the gain. It is 1,500. And we receive cash, so we pay cash. We pay cash 22,500. We pay cash 22,500. This is requirement 2. So total is $50,000 bonds payable. We buy back by 2 installments. Okay, 50% we buy back and we pay some money and we record gain or loss, and another 50% we buy back, pay some money, and we record gain or loss. Yeah, so this is about bond redemption with discount. And if you remember my previous class, I explained bond redemption with premium. Okay, previous example, it was bond redemption with premium. This example is bond redemption with discount. You may have one question from this. So from question 1 and 2, you will have a question like that, and for question 3, like bonds discount with redemption and bond premium with redemption, you may have one question. Now let's see question 4. So the question 4 is about installment note. So this is installment note, and we are going to prepare amortization table. So we are going to prepare amortization table for installment notes. So read the question. Assume that Lewis Company issued the following installment note on to City Company or Citibank on January 1st, year 1. So principal amount of note is given $12,000. So this amount is called beginning carrying value. So beginning carrying value of January 1, year 1. So this $12,000 is called the beginning carrying value of January 1st, year 1. Okay, and you have to remember that 5 years later, what should be the value? As it is an installment bond, so this is an installment bond, right? 5 years later. 5 years later means ending carrying value of December 31st, year 5. What should be the amount? Can you guess? Today is $12,000. So today is 12,000. Today is $12,000. What should be the amount of 5 years later? You don't know? $0, because it is the installment note. After paying 5 installment, okay? After paying 5 each installment is this amount, $2,849. So every year you have to pay this installment, and when you make this payment for 5 years, after 5 years later, you don't have any liability. You don't have liability. You don't have any note, it is 0. So today your liability is $12,000. Okay, today your liability is $12,000, but actually 5 years later, you should not have any liability because you made 5 installments, and every installment is this amount. Now the question is, every installment you paid total $2,849, and it includes notes payable plus interest expense. So this amount $2,849, some part are interest expense, some part are the notes payable, but we don't know which one is notes payable, which amount is interest expense. We don't know. So we have to prepare the table, amortization table, to know this number. So this is the interest expense and this is the notes payable. We should know this number, right? By preparing this table. Now, how to find this? I told you that if you want to solve this question easily, make some ABCD number. A is the beginning carrying value. B is the annual installment payment. Then C is the interest expense. D is the notes payable. And E is the ending carrying value for note every year. So we have a formula to calculate C. How to calculate C? C equal A times rate. A times rate. Here A is beginning carrying value. You know that. What is the meaning of A? A is the beginning carrying value of year 1, right? Then times interest rate. What is the rate? Rate here is 5%. Now how to calculate D? D equal B minus C. If we calculate, if we know B, look at here. If we know B and if we know C, then we can easily calculate D. It is B minus C. And how to calculate E? E equal A minus D. A is the beginning carrying value. Okay, A is the beginning carrying value, and D is the notes payment. Okay, so after paying this note, the remaining is called ending carrying value. This is the beginning carrying value. Okay, this is the beginning carrying value. A, you pay some note. After paying note, you have remaining ending carrying value. So you have to remember this. So year 1, beginning carrying value $24,000. Beginning carrying value $24,000. And at the end of year 5, this is at the end of year 5, your ending carrying value should be $0. So this is, you should know. We begin with $12,000 and end with $0, right? We have year 2, 3, and 4. So why we will have this money 0? Because we are going to pay them some money every year. This is our installment. This is our installment payment. So after last installment, we should have $0. Now for the remaining amount, we need to do some calculation. So let's find out. So this is $12,000 beginning carrying value. And how to calculate interest expense? The formula is beginning carrying value times rate, right? So the amount is $600. The amount here is $600. So we know total amount $2,849. We know the interest expense, like here. If I go back here, we know this interest expense. At the end of year 1, At the end of year one, we know this interest expense. So if you know interest expense, if you know the total amount, you can easily calculate this, right? So this is B minus C, something like this. So the difference is $249. So this is the amount. If we put this amount here, you can see that if we put this amount here, then it is total $2489. Okay. Now look at here, your beginning carrying value. Your beginning carrying value $12,000, and you already paid. You already paid some notes. Do you understand? This is beginning notes payable, right? This is beginning notes payable of year one, and you already pay some notes at the end of year one. After paying these notes, okay, after paying these notes, what is the remaining note? It is about 9751. This is the ending carrying value of your note at the end of year one, $9751. So ending carrying value of year one is the beginning carrying value of year two. You know that, right? Now we know beginning carrying value of year two. We know the annual installment. Now how to calculate the interest? Interest is A time rate. What is the A? A is now 9751, 5% interest. Now the new interest is $487.55. So now we know interest expense. Now we can easily calculate the notes payable. It is 2361.45, and we know the ending carrying value 7389.55. So you know interest expense. So this one you can easily calculate, and this is the ending carrying value of year two. So ending carrying value of year two is the beginning carrying value of year three. Now we know annual installment, we have to calculate the interest. Here interest is 369.48. How to calculate this? This is the beginning carrying value times 5% interest. Now we know this amount is 2479.52. And this is, after that we have 4910.03. So this is the ending value of year three. It is the beginning value of year four. Now we can calculate interest to 45.50, and the notes payable is about 2603.50. And after that we have ending balance to 306.53. Okay. Now year four ending value is the year five beginning value. Now look at here. This two is the important. I told you that previous lesson. I told you that this two you have to calculate by using a plug number. So first you have to calculate this one, because we know that what is the formula of E? E means A minus D, right? A minus D. So A and D should be the similar amount. A and D. A and D should be the similar amount. If A and D is similar, look at here. A minus D equals 0, right? Now, what is the number here? So if you know, look at here. If you know total amount is 2849, and if you know the notes payable amount, you can easily calculate the interest expense, the remaining one, right? So the remaining is 542 0.47. And this is the plug number. In accounting, we call it plug. Plug number means you cannot apply this formula. You cannot apply this formula at the end of year 5. We have to find the missing number. Plug number means the missing number. So if you know these two, you can easily calculate the plug number. So these are the 4 important questions. You must review these 4 questions with my previous class notes if you want to answer some questions in the exam. So this class is very important. Okay. Okay, that's all for today.